Welcome back everybody, thank you for tuning in. Today we will speak about a very excited topic, and that is technology stocks. We will cover everything from their valuation, how high can their stock price go. We will cover some profitable companies, some which are not profitable, and what is ahead of them. I will tell you my opinion, I will give you some bullish or some bearish arguments, as well as some historical data which will perhaps give you even bigger insight in what's actually going on. Even if I don't mention stock that you maybe have or maybe you're looking to buy, things that we are going to cover here can be applied to most of other tech stocks. But as always, before we move on, I would like to give you a short overview of my portfolio. As you can see here, year to date I'm sitting around 30% return with my portfolio compared to S&P 500, which returned around 10% in the same period. The interesting thing that happened in the last several weeks is actually that S&P 500 has outperformed my portfolio. And the biggest reason for that is that most of my stocks are not in the technology sector, which is roaring higher in the last several weeks. That is basically the main reason why I decided to make a video today about technology stocks. As you can see, I have 20 stocks of Alibaba, which might be considered as a technology stock, and I have Berkshire Hathaway stocks. Berkshire Hathaway, of course, is far from being a technology stock, but they do have more than $100 billion invested in Apple. Cirrus Logic is another of my tech stocks, but it hasn't participated in this huge rally, so basically I missed it out completely. Last stock, perhaps in technology sector, which I purchased recently is Intel. I bought 50 stocks. But Intel is not cool stock, it's not going higher, it actually went down more than 20% lately, and that's why I actually made small position around it. But enough speaking about my portfolio, let's go on to technology stocks. We will start with biggest technology company in the world, and that is Apple. Again, things that I will be speaking about Apple can be applied to other technology companies too. And another interesting thing before we move on is that I used to own Apple. I bought it at around $140 and I sold it at $220. We all know Apple kept going all the way up to $500, so I missed a lot of gains, but I'm okay with that. You cannot lose with taking profits. That is my mantra. Another thing, if you are confused with this chart, I am filming this video on Monday. This is when Apple actually had stock split. For every $500 stock of Apple, you got 4 $125 stocks. So basically, you didn't gain or lose anything, but the price of the stock only changed. So as you can see, from March to today, Apple went from low 60s to over $125. So basically, Apple doubled in only 3 months. We'll start with some bearish comments and end this part of video where we are discussing Apple with bullish arguments. So you can decide for yourself which one suits you better and if you are okay with taking some risks for possible gains that are in front of you. So Apple did grow its earnings in the last few quarters, but the biggest reason why its stock moved up so high is because of this. You can see the PE ratio of Apple in the last 10 years was actually between 10 and 20. So investors were paying for every dollar of earnings that Apple had between $10 and $20. And all of a sudden, in last year, price that investors were paying for every dollar of earnings that Apple made went up from $20 to over $35. So perspective about Apple's future completely changed on the market, and PE ratio of Apple went all the way up to 37 at this moment. And that didn't happen for more than 10 years. So you must be aware of what is actually going on, and you must be aware that price of the stock is not reflecting fundamentals, is not reflecting earnings of Apple, but is a reflection of multiple expansion. So basically you are paying double for every dollar that Apple earns today compared to investors which were buying Apple stocks 6 months ago. And this Forbes article tells you why that might be very dangerous. It says that price to earnings ratio has a multiplier effect on stock returns. Over 10 to 20 years, it can dramatically increase or decrease your total return. For example, in the secular bear market of the 60s and 70s, shrinking PE ate away almost all the return from earnings growth and dividend yield. Imagine that Apple grows its earnings from $4 per share to $5 per share in next year. You would be very happy with that, I guess, because that would mean that Apple grew earnings 25% in only 1 year. But imagine that something changes on the market and investors all of a sudden goes back to paying $20 for every single dollar of earnings that Apple makes, instead of paying $35 as they are paying right now. Price of the Apple would go from 125 to 100 in next 12 months. So even though Apple would be earning more money than it is now, multiple contraction would mean that you would lose a lot of money in next 12 months. Another thing this article says is that in 80s and 90s, rising PE more than doubled the return for investors. So it works both ways. That is why I am actually a value investor and I'm looking for low PE stocks which are surrounded with negative sentiment. So perhaps one day when that negative sentiment disappears, these stocks might be rewarded with some multiple expansions and I can outperform S&P 500. At least it worked for me until now. Great company to explain this historically would be Cisco Systems. Cisco Systems is a great company. It's been a very big company for more than 20 years. And at the beginning of 2000, Cisco Systems was what are Google, Facebook, Apple and Amazon today. So it was the star of the stock market, it was praised by analysts, it was rewarding shareholders, everybody was piling in this company, and it was forecasted that Cisco Systems will be the first company ever to reach $1 trillion of market capitalization. And consequently, nobody wanted to miss that, so everybody was buying stocks. What happened is actually that multiples of Cisco Systems expanded extremely wide. PE ratio of Cisco I think went up to more than 100 at the peak of stock price. Again, remember, Cisco was the great company. It was really profitable, it was growing in revenue, in profit margins, in earnings, but the stock price went far away from fundamentals. And fundamentals couldn't keep up with the price, which was growing too fast. And what happened is actually that stockholders of Cisco 20 years after it went down for more than 90%, still didn't reach peak that Cisco reached at the beginning of 2000s. So this chart only tells you and shows you how dangerous can it be to pay high multiples for some company. Of course, Apple is not trading near these valuations. And this is extreme example, perhaps the most extreme example that I can show you, but you understand the point of this comparison. Don't chase the hype train, don't buy just because somebody else bought it, don't try to buy the story. Watch the numbers and watch the valuation. But there are also several very good things which are bullish for Apple stock and which might push stock even higher or at least keep it on these high valuations. So first of all, Apple is becoming less and less hardware company and more software company. Software companies have higher margins and higher valuations, so this might be something that is permanently changing around Apple's company and Apple stocks. The second thing is that in macro environment, you can see that Fed is keeping interest rates at 0%, which means that first of all, interest that you are receiving on cash on your bank account are near zero. And second thing is that, for example, bonds are yielding between -1 if you are watching bonds in Europe to 0.5% if you are buying bonds of the US, treasury bonds of course. So there are not many investment classes which are yielding positive yields. So even though Apple is not yielding 5% as it was 6 months ago, it is still yielding around 2.5 or 3% right now. So when you compare that to other investment classes, if you compare that to yield that you are receiving on your cash or on bonds, you can be very happy with this. Not only that, but price of the Apple stock might continue climbing even higher, because even if the yields would decline a little bit more, it would still be more than, again, you can get on many other asset classes. Now we are coming to technology stocks which had even higher returns in the last several months than Apple did. And one interesting thing about these companies is that in the last several years, in most quarters, all of these companies had losses. So the irony here is that biggest gains, biggest profits investors had in companies that are losing money. You can see, for example, Shopify chart. Shopify went from less than $400 per stock in March to over $1,000 now. You can see Square company, which was trading at less than $50 in March to over $150 now. Another interesting company is Zoom. It went from around $100 to $300, and almighty Tesla. which went from less than $100 in March to over $400. By the way, again, this is post-split. The way that actual wealth is returned to shareholders of the company is through generation of profits. So in the case of these several companies, shareholders are pricing huge profits in the future. These companies are worth tens and tens of billions of dollars. For example, Tesla is worth $400 billion right now. And if price of the Tesla's shares would continue growing at pace of last 3 months, Tesla would be the most valuable company in the world at the end of next year. And at the beginning of 2023, Tesla would have market capitalization of around $20 trillion, which would be equal to GDP of United States. So these companies will not keep going up at the rate that they were going up in last 3 months. So again, shareholders of these companies not only think that these companies will generate profits, but think that they will generate huge amounts of profits. And some of them perhaps will, but most of them will not generate enough profits to fundamentally explain these valuations and these prices. So be extremely careful about these companies. The further stock goes up, more risk investors bear. So if the profits of the future services and goods that these companies are producing do not meet the price that stocks of these companies are holding right now, something will change. They will collide eventually and price will reflect fundamentals of the companies. The only question is, when is that going to happen? Are these stocks going to climb for another 10, 20%, 50%, 100 or 500%? Is it going to last for another week, month, year? But reality and price will collide eventually. There is one more extreme example that I have prepared. So imagine that you organize barbecue for your neighbors. And one of the neighbors comes to you and tells you that he has the company and he is looking to sell it. Then you, for example, you might ask him, how much profit did they generate last year? And he could tell you, no, this is new company, we are building something interesting, we are not generating profits right now. Then you might ask him, okay, how much revenue are you generating? Then he might tell you, well, we are not generating any revenue right now either, but we will generate huge amounts of profit and revenue next year. So perhaps you probably would be very skeptical right now, but you might ask him, what exactly are they doing if they are not generating any revenue and any profits? And your neighbor might tell you that they're building prototype of a product that they will be selling in the future. And then you might ask him, okay, how much money do you want for a company that is not generating any profits, that is not generating any revenue, and only is building prototype right now? And then he would tell you that he wants $15 billion for that company. At this moment, you would probably start laughing at him, but again, if you check this company, Nikola, they are building prototype of a truck that they might be selling in the future, and market capitalization of this company is $15 billion right now. I don't know how bright future this company should have to deserve this valuation, but this type of companies is prime example of stock in bubble. I really hope you enjoyed this video and see you next time.